Hey everyone, Paul here. I want to take a look at Penn National Gaming, ticker PENN, and specifically I want to take a look at some money and income you can make by selling options. Okay, so I want to show you the method that I go through. It's been working well for me. Of course, it doesn't mean it's going to continue to do so, but I'm pretty excited about the strategy. So when we do this, by default, and I'm using Schwab, but by default, if we go to trade, it's going to take us to stock and ETF. So this is just the normal screen to buy stock. We can go over to options if we're eligible to do so. In this account, I hit put, and after we do that, I'm going to go to the sell to open. I'm going to go ahead and put the market order in here so we can just see the actual amount, which is going to default to the bid. But what this is doing, this particular transaction is saying that by 8:20, if Penn National is below $70, I've still got to pay $70 for them. It's going to be for one options contract, so quantity of one, and every options contract is actually 100 shares. So I would actually need $7,000, 70 times 100, to be able to purchase all of these at this price. Now, what do I get in exchange for that? And I'm making this deal that says if Penn National falls below 70, I'll buy them at 70. The maximum risk, the worst case scenario is in 8:20. The company goes bankrupt, they're at zero. I've still got to pay $7,000 for them. That's the absolute worst case scenario. That represents the most risk that I have. So again, that's the risk. But what I get out of it is this 147. So I'm filming this on August 14th. The market isn't open. I can't actually make this trade if I wanted to, but this is an example of a trade that was available to you on 8/13 on Friday. So I have a little quick calculator that I like to use. Let's go take a look at it. And I'm actually going to back this up to 8/13 because it makes more sense. And we can kind of pretend that we were looking at this on Friday. So what this is doing, we've got the date that we are in today, and I've got three different kind of buckets here, and this is just if I wanted to compare multiple options together side by side. So I've got today's date, the date that the contract expires. This is going to calculate the difference. So in this case, it's just saying, hey, it's going to expire a week, from when you're going to be writing the contract. The strike price is 70, meaning again, if it falls below 70, that's what you're on the hook for to pay. And you're getting $147 for that transaction. Now, it's not entirely, the most accurate way of looking at it, but you could say to yourself, well, what would happen if you made this deal every week? And by the way, Penn National is at $70.84. So what if every week you sold a put that again says that you would have to buy Penn National for basically $1 lower than the market value today? If you did that every week and the stock never fell within that dollar and you were never assigned the stock, like you never had to actually buy it as a result of selling the option, well, if that were to happen, that would result in a total amount coming to you of $7,665 on an annualized basis. And I found that just by saying, just quite simply, hey, if you're able to get 147 for 1 week, do that 52 times, you get 7665. Okay, and then when you compare that to the cash that you had to put out to get that, which was the $7,000, that represents more than 100% return. And the reason that return is so high is because that's fairly unlikely that's going to happen, that you're never going to have that fall below your price. So it's fairly likely that you would actually get assigned the stock at some point throughout the year. But what you can do with this is you can start to play around with different combinations too, right? So you can say, okay, maybe 84 cents is too close on this. So maybe you want to give a little bit more of a cushion. And yes, we're going to be sacrificing some income, but maybe that helps you sleep better at night to know that it's, just the price point's a little bit lower that we're on the hook having to buy them at. So let's drop it down to $69. Well, then all of a sudden we go down to 107. We can go back to our calculator and we can say, okay, now we're at 69. So now we're only on the hook for 6,900, but we're dropping down to 107. And then all of a sudden the annualized return drops down to 80%. Well, we can show that one more time. Let's drop it down to $65. This says, again, from 8/13/2021 to 8/20 2021. So in a 1 week span, if Penn National falls under $65 from 70.84, you would have to buy it at 65. And for selling that option, you get $26. Let's go back over here and plug that in. So we're gonna update our strike. We're gonna update this here. We're gonna get $26. And that still represents, if this were to happen, so if every week you were to say, hey, I think Penn National is gonna fall by $6, if it never does that for a whole year, which again, still a little unrealistic, but giving yourself $6, maybe a little bit more realistic, a little bit more of a cushion there. But that would equate to just shy of about a 21% annualized return. Pretty good, right? And this becomes, again, this whole approach to selling options as a way to acquire stock becomes really interesting when you really already like the company anyway. And it has the potential to just give you even more kind of, I guess, again, more cushion, more favorability, a lot of those things. So Penn National, in my opinion, is a stock that, should be or will be, back over $100. So I believe the valuation of Penn National is in the vicinity of $100. So if I already think that they're undervalued, right? If I already think that they're a good buy at 70, then the fact that I'm able to get paid to buy them if they fall even more is something that I really appreciate. And I think it's also a good strategy in today's market where it's like there's a lot of uncertainty, a lot of talk about, is the market going to crash? What's inflation going to do? I think there's a lot of some reason out there to be a little nervous, be a little jittery. And by selling an option, again, as a means to acquire the stock, that allows you to kind of have that cushion. So now let's talk about it on the flip side. So if we're selling a put, let's say that the stock does fall, okay? And let's say, in fact, that the stock falls, let's put it back. Let's say this $70 example again. So let's say that by next Friday, so at the option expiration, that this thing goes to $60, okay? So now we have to buy it, and that's not an ideal situation, but now the stock price is about $10 lower. But what we can do is we can now turn this around, and this is where it becomes kind of known as an option wheel, because you kind of can turn this transaction around and say, okay, well, now if you own the stock, you can take a look at selling it out at a later date. And if you had to pay 70 for it, okay, and if from 70 to 60 is a $10 fall, so to make it kind of comparable, I'm going to say, what could we get, right now comparing 70 to 80. So 70 to 80, we're just going to pretend it's kind of like comparable from, 60 to 70. So we're going to pretend that, we bought this at 80 now, and that it's currently at 70, so we're $10 underwater. And if we do this, well, now we're able to turn around and sell somebody the right to buy the stock from us. And so we're going to, again, put ourselves in a situation where we're going to get paid to buy the stock, and now we're going to get paid to potentially sell the stock. So again, that's kind of what's known as an option wheel. An interesting, I guess, kind of strategy. And to me, it's something that I've really become quite excited about. Now that we've talked about this in theory, I actually want to, though, take you over and show you some transactions with Penn National that I've actually done. So let's take a look at some actual trading history. Okay. So for Penn National, this has kind of got a date range between June and August. I've been selling options since the middle of May, so still relatively new to it, but again, just to kind of show you some of the history of what I've done so far. Now, the things that I've highlighted in green here, this is because there was a couple transactions. So I'm actually, from two options that I sold, resulted in me having to buy Penn stock. So this transaction, I had to buy 100 shares, and I had to buy 100 shares here. So this transaction had a strike price at 70. This was 71. So in total, I had to spend $14,100 in purchasing the stock. Now, I got paid just to buy that stock. I got paid $110. Not huge money to buy it, but again, it was something that kind of offset that. And then in the meantime, so again, I was assigned the stock based on those transactions. But in the meantime, you see a lot of these other kind of gray and white lines. These resulted in I sold an option, I would get a certain amount from it, had an opportunity to buy it back for a lesser amount, resulting in a profit. So these other lines were profitability. And these other lines of getting paid to sell the option and then buying it back for less, those added up with the amount I got paid to buy PENN. Just those lines resulted in $819. And again, so then I had to buy PENN National for $70, and we just saw on the other screen, of course, is that in today's world, in the close on Friday, PENN actually closed over $70. So again, I had to buy it at 70, but even right now, it's worth more than that. And then on 8/5, so after making a series of different kind of trades and selling options and closing them when I was getting what I thought was a good profit to lock in, I ended up selling an option that expires on September 17th, where I got $334 per options contract. So to sell my 200 shares that I own, which was $660 that I received, to sell them at $70. Now at that point in time, let's go back to that, because again, that happened on August 5th. And that was for a transaction on 9/17. And I want to kind of take you back to the calculator and walk you through why I ended up making this deal. Do our Excel. So let's pretend that we were back on 8/5 and the date of that options contract was 9/17. Our strike price was 70. That's the price I was going to sell it at. And I was getting $334.35. So that's what I was getting there. So when I was sitting back, on August 5th, right? So about 9 days ago, I realized that by selling this, that I would be putting myself in a situation where I would essentially be getting a 40% return to let somebody by September 17th buy PENN stock for $70 from me for a premium of $334 per options contract, right? And so I had to ask myself, I had to say, okay, would I be happy with a 40% annualized return? And my answer is yes, I'd be thrilled with that. I mean, I would love to be able to get somewhere in the vicinity of 25 to 30% with this strategy on an annualized basis. So being able to lock in a 40% return, which by the way would also be on the back of the other $819 I've made. So that would be all incremental, right? I would have been absolutely thrilled to do that. So I said, okay, I'll make that deal. Now, here's what you have to be able to live with when you do that, right? You'll be able to live with the fact that PENN National might, by the middle of September, blow up to $90 or 100 or 200, whatever they might, go up to, right? If that happens, I've still got to sell them for 70. That doesn't mean that I've actually lost money on it, because remember, I paid $70. Well, I mean, 14,100. I paid 70 for one, 71 for the other. Even if the stock goes to $1,000. That doesn't mean I lost money on the deal. It just means I didn't make as much as if I would have sold it at a higher price. So I feel like I had to be okay with that 40% return. As I already said, I'd be thrilled with it if I got it. So I sold it. So now that's the only open option that I have with PENN right now. And now if we kind of add everything up and we include the 334 and the profitability here, that takes it out to, since June, which by the way, the bulk of these transactions were July and August, I've made about $1,500 from selling options for PENN. So kind of some examples about, a real application of the options wheel, how I've been able to make it work with PENN. Definitely no guarantees. Do your own research, do what works for you. Wanted to share something that was working for me. I'll continue to share updates like this. So if you guys want to see more videos, be sure to like this video, subscribe, hit that notification bell, and we'll talk to you next video.